Let's move on here. And again, my name is Scott Ebeling. I'm head of energy strategy and client solutions here at Box, and with me is Allison Black, certified energy procurement professional and manager of pricing and strategic solutions. We're going to be talking about Box today, market update, how to control non-energy costs. Thrive 2026. That's the UpDirect event, our parent company, and you guys are all invited to that. And then some closing thoughts. So, first of all, let's talk about Box. Take it away, Allie.
Awesome. Thanks, Scott. And thanks, everybody, for joining us. We apologize that we couldn't do this live like usual, but we are really happy to deliver still some really good content today. Excited to be talking about our non-energy costs in a little bit, but want to take a minute to introduce Box for those of you who aren't already familiar. Box is your ultimate commercial energy brokering partner. We provide independent energy brokers and affiliates with access to all top electricity and natural gas suppliers, instant pricing, and cutting-edge software, all supported by industry experts. Box has become the largest network of energy agents, brokers, and consulting firms, and now advisors in North America. We connect a variety of diverse energy partners so each can benefit from streamlined, efficient options in deregulated gas and electricity. You can see how you can scale your energy business nationally with our deregulated energy map, which you'll see up on the screen. You'll see natural gas items available in green, natural gas and electricity markets available in blue, and then you'll see a fair amount of the West and Midwest that is limited availability. We do have some gas suppliers in these areas, and truly all of the lower 48 is deregulated for natural gas. So if you have a very large commercial customer in these areas, we may have a supplier who is looking to bring on load in that area. So exciting stuff, really easy to, if you've only done business in Pennsylvania or are only licensed in New Jersey, to then serve customers in neighboring states and expand your business nationwide. We can do that, and we can definitely help you do that through our supplier relationships, some of which are shown on the next slide. You'll see a lot of names that you know here: NRG, Constellation, NextEra, some of your bigger brands, but you'll also see some other brands in there: FreePoint, CPV, guys who really work closely with the broker community and with the advisor community and consultants, really strong, capable suppliers who are also have really strong backbones and able to compete for major customers. We've got a ton of relationships here at play, and we are happy to put those to work for you, whether that is through our very streamlined automated matrix comparison and get commercial rates side of our system, or whether you're bringing something to the pricing desk, you're wanting custom pricing, or potentially even dealing with our strategic solutions team and looking at managed product. We've got a little bit more about our strategic solutions team on our next slide. Buying electricity can be really complex, and with complexity comes the possibility of customers signing contracts that don't include components they anticipated or don't cover all the costs. And Box's goal is to ensure that the customer gets the best deal and contract terms possible on the marketplace. So we provide tailored sales strategies, bespoke product design, data-driven insights, pricing optimizations. We do have a reverse auction platform available for anybody who knows when their target execution date is. We provide contract negotiation assistance and have negotiated custom contracts with several of these suppliers that have language that we've negotiated just for all of our customers, for all of everybody who is custom, who runs through our desk. And we provide seamless client support and proactive solutions as well. We've got an entire team dedicated to renewals and who can really help you renew your business. If you're looking to just keep growing, keep going, keep monetizing, and want to keep your focus on new business, come talk to us about automating and getting some support for the renewals side of your business. We are happy to support you. We can provide all of the pricing, reporting, anything that you need on that side. So happy to do it. Box's goal is to support our community of aggregators, brokers, and consultants here. So we really love what we do. We're here to work for you and here to help you guys look like absolute rock stars in front of your customer and like you guys know what's going on in the market. So on that note, I will pass it back to Scott for our market update.
Thank you, Ellie. Yeah, so we'll be going into some of the more of that stuff about kind of the contract stuff and what's in there and what's not a little bit later when we talk about the non-energy costs. So market update. Not as the last couple of months we had Fern in February we were talking about. In March we were talking about the the Strait of Hormuz in Iran, and this month we're just going to talk about kind of some of the stuff going on in the market and the storage and all that, and there isn't any crazy things going on, but with that there is the price action that has happened in the past month here. Natural gas down about 20 cents on the month, but we had some power price movements here in mid-Atlantic was up 18 cents, and Texas was down $5. Finally Texas is kind of showing getting down to the value level that we thought it was at. So we'll go with that in a second here, but yeah, there's some pricing updates there. That's all on peak power prices. So first, let's look at the natural gas chart here for NYMEX. Wow, here we are, just continuing down here. We're at 360, 370 area for all the term markets, 27, 28, 29, the calendar years. This is where you buy. We understand the actual front month is in the 260, 270 range right now, but typically customers are buying out in this period here of 27, 28, 29. These are the calendar years. This is where they are buying at. So with that, then look at Texas prices. Again, come off pretty nicely here in the past month or so, down $5. Like I said, really hitting into levels here that we find at a kind of true value kind of point of view here. And then PJM, they're actually really haven't moved much in the past month, and they're really up on the year. And so with that, I want to point this out. So see, PGM's higher, Texas has dropped, and it's well, why are these divergence here, and what's all this cost? And that's what we kind of some of the stuff that we really analyze here to kind of see value. And with that, we see kind of a power price divergence here. And here's just since 2027 to 2027 power price calendar year. Here's where they are since the beginning of the year, and you'll see here PGM has drifted higher, while ERCOT has drifted lower. One could say Winter Storm Fern and the potential high LMPs had a big impact on that. But they're really, that all took place here from about this period here, and we had an initial spike, but then that really wasn't much of it. This is kind of where the warm weather started hitting up here, and really since this whole issue in Iran started taking place, it's kind of lifted up here. Which really kind of is surprising and trying to figure out the fundamentals. Well, of course, ERCOT's drifted down. Basis gas, very little of that. There really been a huge much of a basis gas movement change in PJM. There has been a little bit ERCOT, of course, with the associated gas coming on. But and then what we really look to, and this is going to get really more technical into the weeds here, Geeky, but it's going to show you the chart. This is what we kind of analyze. It's called PJM heat rates. It's heat rates, PJM heat rate, ERCOT heat rate. Heat rate is the power price divided by the gas price. And you can see here that this is definitely lifted up in PJM. ERCOT has come off. So with that, we see the price movement in ERCOT wasn't just about the natural gas price. It was actually kind of this movement down in general. So we are finding out ERCOT. We always thought it was $3-4 overvalued here. We're saying a lot. We are now considering ERCOT to be relatively fairly valued for the risk reward situation in place. So go ahead, get your customers in that. Buy. And in PJM, we find that to be, and that's basically at the fair value where gas prices are now. It's agnostic compared to where gas prices are at. So we find it to be fairly valued. This heat right here, this 12 to 13 level. That's a good fair value. Where we find in PJM though is that's lifted up, and you can see here the big lift was right around here in gas. This is when the weather started warming up, and we now have had a lift off here about $1.50 change in the heat rate. And really in Winter Storm Fern, it relatively didn't really move all that much, right? So so with that, we think PGM and is kind of got over its skis a little bit here of $2, $3, $4. So yeah, do accordingly with that. and check it out. We recommend strike price agreements, stuff like that. We think this is the fluff of this will come out over the next couple of months. Looking at this and talking, and again, getting the weeds here, I as a former trader, I have a lot of friends, colleagues, former colleagues, all that are traders. I went around the horn talking to them. What they're seeing is a lot of price action from the hedge funds. They're looking to buy something. I've said it before and I'll say it again. There is not a lot of power traders out there compared to what it's funny because there's a lot of things that are needed right now. Like we need there's a shortage of natural gas turbines. There's a shortage of construction crews to build out data centers. There's a shortage. Everything's just kind of a shortage of the power side. There's actually a shortage of power traders out there for the hedge funds to hire. So they just bring somebody in and say, hey, why don't we trade power? And they think like, oh, we need to buy something in here because should get bullish on power. So the most liquid market is PGM, and I think they'll just bid it up here. And that's why we saw this $2-3 movement, and that will come out. We had a washout of them last spring. I think it will happen again eventually. So getting into that, ERCOT index prices, not much here. Again, this is in the 20s for the last couple months. We'll probably see this continue for the next couple months. And of course, summer comes around, and we could have one of these big months in the summer or not. We'll see what the sustained heat is. PGM West Hub, it's come off as well. And of course, we had that big move in the winter time with Winter Storm Fern. And we also had, $7-8 gas here as well, but that's come off. And in New England, we want to look at, of course, and New England is the one that's highly affected with much more tied to what's going on in the Middle East, because they're competing for the LNG in the wintertime with gas, and these winter prices have gone way up, which is lifting the calendar years up as well. And you can see that this is just kind of, that's a risk. Of course, here it is. This is competing for LNG, and of course, those prices have gone up. The foreign LNG, so what's come up? But of course, here it's back to regular LPs. Because why? Because that LNG imported gas is not the one on the margin right now in these kind of perfect temperatures that we have. Let's look a little bit now. We've updated these charts. You'll see them next week on the weekly update charts. I'll probably put a little LinkedIn post about this as well. But this is U.S. LNG export capacity. This is the part here to really pay attention to. If you work on a story to tell your customers, here it is. As I said before, we think where gas prices are now, we think power prices are fairly valued in ERCOT. We think they're a little overvalued in PGM. But gas prices can go up, and we think they will. And here's really the story behind it. U.S. LNG export capacity. This is number one. And here we are current, and in 2026, cool. Boom, boom, boom. Yes, this is priced in here. Okay, this we need to add 5 more BCF of gas. Okay, we need to add by end of 2031. That's in 5 years, 14 BCF of gas just to get this LNG export capacity. Now, I don't know if we are importing that every day or not, and that's another question. I'm going to talk about that probably next month, about why I see now there's even the big risk is that we're not importing that every day, and I'll discuss that, like I said, next month. But here's also natural gas demand. Is our demand coming on as well? The power burn, especially you see a lot of stories now, data centers is co-locating with new natural gas turbines. We get calls on this all the day. And with that, so the low case scenario is a 14 BCF movement between now and beginning of 2032. The medium case, and this is right here, this is the medium case as well. This is all stuff that is constructed, is under construction, by the way. And with this whole LNG situation, US is now, is a much better place to probably potentially ship this out than Qatar. So we have the case for investment in new ones has grown up, and it takes only 2-3 years. All these are $10 billion of fund, so this could go up, and this is why then we have a high scenario of maybe adding another 4.5 or 5. And again, these are all can all mix in, but kind of we've got the potential here really of this low case. This is kind of recessionary kind of thing going on, deep recession of 14 all the way up to 31. So we need to add gas no matter what. We're going to need to add gas. And, you know, and so with that, let's look at the natural gas storage. And maybe we should look at this slide earlier. This is a forecasted here. So we could look at this, and this is already has the next one in here where market's expecting it to be. So we're kind of like forward looking, and kind of pretty much at the end of April here, we're expecting to be over 100 BCF a day above the last year's and also the 5-year average. So trending nicely compared to Infern. We thought, boom, we'd be down at these levels potentially in the winter, but we had a really warm end of February and March, and we kind of were able to kind of get into the 5-year average. Now we're having a pretty much perfect April. But let's go back into it. So here's natural gas production. Like I said, we're going to ramp this up 20 BCF, you know, in the next 5 years. So this will have to go up 20 BCF in the next 5 years. We're just kind of like hanging in here. Yes, everybody's talking about associated natural gas. That's coming on. Just to let you guys know, probably 2.5 BCF. Just gas coming on really any prices, because oil will get jacked up here, because as far as production goes, because it's kind of definitely a money to be made, and the forward curves are getting pushed out. So with that, I also want to then talk, Dan, this is the other part of it. We actually put a blog post out about this a few weeks ago. Why decline curves matter for long-term energy risk. This is a big story. So not only have to increase our production 20 BCF, but the current production we have, it's losing. If you see in this curve here, this is the curve. This is in this story. It talks about this some more. We lose gas as we do a new well. Boom, new well. So all these wells here are going up. I like to say currently we're at this 113 BCF. If we do no new drilling and no new wells for the next year, we're just automatically going to be down to close to upper 90s in production, just because of that, because we just have this decline. So it's even more to make up in production. And yeah, click here for the blog post on this in the PDF that's attached to this and be sent out. And then this the rig count. This is what has to be done. You have to do these rigs and drill up some more. We were at 160 about a year and a half ago. So these are just kind of the numbers here over the past year. Yes, we've ramped this up. It's good, but kind of like stalled out here. This is usually about a 6-month leg. So this ramp up here is that we had here should start showing up and coming up here in production. But again, they're being disciplined. They're being very disciplined. And this is why producers have stated the break-even level of gas. So 90% of the producers out there are saying the stated break-even level of gas is right here at $4. We are well underneath that right now, 360, 370, 380. And they're disciplined now. They're not just producing because they've already thrown cash at us. Now they get, you know, kind of their cash flow going. They're willing to be sticky with this. So again, we see this almost as an asymmetric trade here. Asymmetric meaning that there's really only kind of one way it can go. Maybe there's a 15, 20 cent floor here, but there's tremendous upside here as well. This can go up 50 cents to $1 over the next year, and then lift the power prices up with it, because heat rates is naturally power prices go up with gas. So with that, those are all the story to tell. You know, gas is going up, and gas is what's on margin and power. So if you're not selling gas, you're selling power, gas on the margin, and with that, we need to, and gas demand's going up. We need to increase production to get there. We're losing production, and producers also aren't going to do anything here under $4 to really kind of lift it and get us out of this to a tremendous level. So a couple box market insights. 78% of Americans fear data centers are raising their energy bills. This is going to be a big political issue coming up here in this midterm and going forward probably through 2028. Globally, air conditioning might be as big a grid threat as data centers, and that's globally, not necessarily America, but just kind of, you know, sometimes people don't understand that as the world gets wealthier, and then China, India, For instance, huge population centers are there, like, multiple times our population. Comfort is a big thing, right? So, and in the summertime and when it's warm, they want to be comfortable as well. And air conditioning can easily make your life a heck of a lot more comfortable. I think everybody here in Texas understands that. And then ESG finance is advancing quietly despite political headwinds. This is kind of a shocker for me to see these stats, but globally, 23% of companies now carry net zero targets. 31% of banks have active coal finance research, and upward 40% of assessed financial instruments offer sustainable target. That's a jump from 2023. So from today, since 2023, it's been like a few percentage points jumps in all these, but it hasn't been a drop. And which a lot of people, the stories out there is that it's dead, it's going away, and it's not necessarily. As always, it's been more of a kind of a self kind of values sort of thing within the companies and within their industries and with their ultimate consumers. So it's continuing. Finally, gain a competitive edge with Box. We have weekly market updates we send out. If you're not getting these, let us know. We have our blog posts we put out there. And we also, just to let you know, we have all these other tools. We get on customer calls with you, all this stuff on our team. We also can build out customer presentations for you as well as we get in these calls or help you with them. So with that, I'll stand it off now back to Ellie. And she can now talk about how to control your non-energy costs. Take it away, Ellie.
Awesome. Thank you, Scott. Great market update. I know I know we usually do a little bit of Q&A. Obviously, we can't do that this time since we're recorded, but I want to take the opportunity to go ahead. If you guys have questions, go ahead and leave them on the recording. Go ahead and email us, Allison at Broker Online Exchange, or Scott.Ebeling. We're here to answer your questions, and it's a really interesting time in our markets. There's a lot of change going on. To tackle some of those changes, some of you guys may have seen, whether it's an ESG program or whether we're talking about PJM capacity, you guys may have customers who are going, what the heck is going on with my energy bill? Why is it so expensive? So we want to talk about non-energy costs. Scott did an awesome job of letting us know what's going on in the energy space. What's going on with your actual energy cost per kilowatt hour? What's going on with the fuel costs that then tend to dictate the electron cost of actual electricity. That's all talking about your actual commodity price. That's all consumption-based items that as your meter spins, as your business uses energy, or as your customers are using their energy, those customers are consuming energy, and we're talking about that as the actual consumption piece. What does the customer pay for the energy that they use from a commodity standpoint? And that's the part where you have real exposure. That's the part where we're talking about, we're talking about spikes in the market. We're talking about congestion. We're talking about what happens to real-time pricing if a generator goes down. And we're talking about forecasts of peak demand, of peak load, of these load maxes and reserve margins that are tightening. All of that has to do with how much energy is actually running through the grid real time. That's all real-time exposure, that's real-time consumption, that's real-time balancing. So that's the energy stuff that we're talking about. But this webinar and our feature is to talk about our non-energy costs, because as it turns out, there are a lot of costs that are related to other stuff. Not necessarily what you're using, but potentially what your demand levels are, or what your tags say, or what your state has decided is going to be a program that every ratepayer is going to pay for. So we call those non-energy costs. Those are listed up here on the screen. They're capacity, transmission, ancillaries, and really we broke these out into the most major buckets. Every market is a little bit different, and we'll look at that a little bit on the next slide in terms of how these ancillaries and these costs shake out and compare to the actual cost of energy. Capacity exists in just about every market, but ERCOT. We know that ERCOT is an energy-only market. But capacity is your payment that keeps power plants available. Transmission is your cost to use the high wires when we're talking about transmission shortages. And Scott's talking about, well, hey, we know that we're having transformer shortages. We know we're having transmission shortages. Those are the costs that are rising, and some of those costs live on the supply side of the bill. Now, why some of these costs, like ancillary services or administrative fees and grid fees, live on the supply part of the bill, that's really up to the regulators. I know that we're not we're not fans of throwing costs onto your supply price just to have a financial mechanism to get, to collect money. But this is the way that regulators have said, this is what's going to go into a supply price. And so part of those supply prices are for future capacity, for future transmission build out, for grid programs, or for renewable goals that your state has set. I know ERCOT's got some, and New Jersey's got RPS, and so does Pennsylvania. A very small portion is allocated to losses. That's really more of a consumption component, but your ancillary services are all bucketed into one piece here. So all of these costs can be substantial to your customer, really top to bottom, starting with capacity. Capacity can cost your customer. I mean, in PJM, we've had some customers where they're paying as much for capacity as they are for energy, just depending on their tag. So looking at these, being aware of your capacity tags, being aware that there's a ton of cost that does not relate to energy consumption necessarily, is very, very important for educating your customers and to walking them through why the numbers look the way that they do right now. If we move into our next slide, you'll see the way that those costs actually shake out. So you can see how big capacity and transmission are in PJM. You can see those transmission costs are catching up. You can see in NISO how much capacity costs in comparison to energy. And you can see the bigger part of ancillaries that's starting to eat into the ERCOT breakdown, just since Winter Storm Uri, and since we've had more state programs like ECRS and securitization that have come online. So these are not negligible costs. That's the point of this slide, is that these non-energy costs, regardless of the fact that they are, they're might not have to do with consumption. Maybe they have more to do with if the customer comes on and turns on all of their equipment all at once. It likely has to do with when the customer is hitting their peak usage. And if the customer is hitting their peak usage at the same time that everybody else on the grid is hitting their peak usage. Those are the types of things that go into the calculations and basically the calculations and the numbers and the costs that your customers end up paying. Some of these costs are referred to as obligations. So your capacity obligation or your transmission obligation. What happens is that the grid will take a measurement of how much energy you're using, or that account is using, at the time when the grid is peaking. Basically, if everybody is on pulling the max all at once, how much does this customer need to pay for? And so they allocate those out using those measurements, which are then called tags, whether that's a cap tag or a transmission tag. And those are then allocated out to customers so that that money can be collected. We also do have some major costs in terms of ancillaries, both in New York and New England. We're going to talk specifically about some New England costs. I know for a lot of New England customers, there is a new ancillary program called DAISY, or DAS, D-A-A-S, or D-A-S-I, which is day ahead services. This is a winter reliability component that comes into play whenever additional generation is needed. And this winter got very cold. Additional generation was needed. It's very expensive to call on those generators and to call them into the market. So price spiked. Price spiked for a lot of customers significantly over this winter. But that's an ancillary component. It's not necessarily energy related. It's something that's a regulated component that basically state lawmakers have said, yeah, if we have to turn this on, then that cost goes, under this program and everybody pays it. Now, the challenge for some of our suppliers is that these non-energy costs may or may not be hedgeable. the way that energy is. Energy is traded in forward markets. Energy as a commodity is traded in blocks and megawatt blocks that are then settled financially all across the nation. These costs are not necessarily. How each of these costs break down, how they're calculated is all really up to regulators. Now, regulators do have formulas that they've applied to come up with the capacity market and really to design the actual function of all of these costs and dictate where all of this money goes. But the thing about a program like DAISY or DOS, or even potentially like some of the capacity spikes that we've seen in PJM over the last couple years, how capacity moved from the $40 range into the $300 range. Those are things that we as energy professionals, we can see them coming. We can say, hey, you know, we're seeing forecasts for this. We're seeing programs come out around this. There is cost risk here, and we do. But until those figures are known, it's not something that suppliers can anticipate. It's not something that can be necessarily bundled into a fixed price. And that's not to say that, I mean, we've done the math several times for a lot of different customers who are looking to pass through capacity rather than fix it so they pay their actual cost. That's not to say that bundling the cost is even the best move for the customer or is the most cost effective. A lot of the time, passing through these non-energies and hedging your energy, fixing your price for energy, the volatile commodity, and passing through the prices for your non-energy components, which are calculated costs according to more regulated formulas or more controlled environments, passing those costs through while fixing your energy might be the thing that makes sense. So if you're interested in talking about that, if you're going through it with a customer who has some aggressive goals, we're happy to help. We're happy to have that conversation. It's not necessarily magic. We can't wave a magic wand and make those energy costs go away. Just because you're not fixing those costs doesn't mean that the customer doesn't have to pay them, unfortunately. But it does mean that we can help you contextualize and we can make a recommendation as far as the way that these components could be treated for cost optimization for that customer specifically. That's the work that we do. So you'll see these supply costs broken down really differently depending on where you are. You can see a PPL bill in our top right here, and you can see that we have transmission charge, and then we have a generation charge that counts for capacity and energy. So capacity was a tag and energy is consumption. Why those two things are lumped in on the bill is that's the way that PPL bills it. It's not necessarily the same way that a supplier would break down the cost components. Likewise, below that, New York, we've got supply, we've got demand, which is likely your consumption. We've got some other charges, but there's other components in New York too. We've got TOTS in New York. We've got aggressive CES in New York. That's not itemized on this bill. You see your ComEd supply that's broken down. You've got electricity supply and you've got transmission over there on the bottom left. That doesn't say anything about capacity, but ComEd is in a capacity market. Where is that charge? I don't know. And then, I mean, I love this, just a single line of default energy supply from Eversource, which has, I mean, a arm-long list of energy components that's going actually into that supply price. So point being, utilities don't necessarily break these costs down. We can help you do that. We can help through what is a demand charge, what's a consumption charge. We can help you sort through what's a what's a energy charge versus a non-energy charge. And we can help you, and we can kind of help to start sorting through and make sure that even if you're not reflected, like I said, the same but different, even if we aren't able to see a apples to apples comparison component by component on the bill, we can absolutely break this out and again, make those types of component recommendations. Now on that, whenever we're talking about fixed, we wanted to highlight particularly for these pieces. Now fixed, truly, whenever it's coming to a component name, fixed refers to the commodity treatment. Customers want it to refer to the entirety of the supply price. But unfortunately, because we have moving markets, because we have items like PJM capacity or programs in New England like Daisy, those things may or may not be hedgeable. Regulation and government risk is not necessarily hedgeable. So a fixed product, you can absolutely hedge your energy. The supplier can go out and make that purchase for you, and you can reimburse them over time. That's how they fix an energy price. And assuming that you are right on target, and you've got appropriate swing provisions, that energy price won't move. However, in markets like PJM and New York and New England, we have more that goes into that overall supply per kilowatt hour rate, and some of those components are not hedgeable. Thus, if you're looking at a fixed all in rather than a fixed energy only, that fixed may not mean fixed. So buyer beware. Even if a component is listed as fixed, suppliers may still be able to make adjustments midterm depending on the contract language. And we'll look at that contract language. We actually pulled a lot of different examples on the next slide. So understanding which components are included in the contract price and which are excluded is critical. We can provide these budgets. We can provide overall per kilowatt hour budgets depending on what components are in, what components are out, what components are hedged, what components are floating. We can help you guys do this math. Just because you're passing through a component doesn't mean that its cost has to be a mystery. And again, just because you're passing through a component doesn't make it free. So we are happy to help with any of those estimations. Again, passing costs through can work to the customer's benefit or to their detriment. Every customer is different. So doing that math and making a recommendation based on the particular customer or even the particular account is something that we can help with. We can analyze, make a recommendation, and negotiate specific contract language to optimize treatment for every component, regardless of whether that is energy and the customer has a strategy as far as maybe they can load shift, maybe they've got some flexible load, maybe they can do some demand response, or maybe they're or maybe we're looking at a customer who's interested in being more efficient. The cheapest and cleanest kilowatt hour is the one that you don't use. So if a customer is doing an LED retrofit and their consumption's coming down, that also means that their capacity tags are going to come down. That means their transmission obligation based on the grid measurements is very likely going to come down. We can help with all of that. We can help regardless of whether that's looking at demand charges or looking at something that's a little bit more consumption based and coming up with a hedge strategy for that. But again, like we said, fixed may not mean fixed. It just it depends on the product structure, and that fixed truly pertains to your energy cost. So check your contracts. Even if you have a capacity, transmission, even if ancillaries are all listed as fixed, you have a component breakout and it says fixed on it, do check your contracts, because if that component breakout says fixed, but then says, well, it's fixed, but it's also governed by our change in law, or governed by Section 5, or governed by something else, that may not be as fixed as you want it to be. We have some examples of that language on the next slide, Scott. So a lot of this language comes into play with change in law. You'll see that in 4 of 5. And these guys are our big suppliers. I've taken names out, I've anonymized, and for any supplier who watches this, we're not calling names. We're not, everybody does this. And truly for suppliers, this is the CYA that they need to be able to offer a fixed price and to be able to offer customers the ability to move away from the utility and to fix their price at all. But this language isn't just about every agreement. These are big name brand, top tier suppliers, but they still have this language that if a change in law occurs, if there's some change to a regulatory program, whether that's a new program or they're changing the rules, the customer is still liable and obligated to pay those costs that weren't in the supplier's original forecast. This is pretty universal. Yes, you can sometimes, make arrangements with suppliers, have them stack. And really, if you make an arrangement with a supplier to say, hey, I want this to be fixed. I don't want there to be any chance of this changing. I don't want any change in law. I want this section out of the agreement. What that's going to look like is a ton of extra premium that your customer is paying for nothing else other than their cost staying the same. Now, if a customer absolutely needs their cost to ring in exactly true for the next 2 years on their supply cost, we could try to help you get there. But again, with all of these components coming up, all in and fixing those components may not be the best and most cost-effective option for your customer anyway. So we really encourage you guys to break this down, to familiarize yourself with these components, understand where these costs are coming from, if it's a consumption-based cost versus demand-based cost, if it's something that actually has exposure to energy markets, to moving commodity volatility, or it's something that's a little bit more state regulatory legal risk. That's something that's really helpful in terms of contextualizing these changes and looking at these costs, explaining what they are, where they're coming from, and why they may be increasing to your customer. Scott, I think that's the end of my piece on contracts and non-energies. Do you have anything you want to add on that?
Yeah, thanks, Allie. That was great information. And I think what's really important to understand here is that message, and we'll repeat it again. Fixed does not mean fixed. It really means is that this is just, we're bundling these charges up into one price versus separating them out. If I was a customer, I choose to look at it separately, right? And most customers that we're dealing with they're fixed, they call it fixed all in or fixed whatever, and it's bundled fixed. And customers want to see it. I think it's a great way to kind of flip the table when you're trying to get new customers and show them something different. Like, wow, you buying all that, here's why you should do that. It's a way to show value right off the bat. And when you're talking to a customer, like, oh, you buy it like this, well, let's continue buying it like this. That's not really bringing value. So it's a way to bring value and explain to them all this, and explain to them all these changes in the law that we're looking here on the screen right now. These are all in these fixed all-in contracts. This language is here. So if there's new invitation, like the DOS law and the DOS ruling or the DOS charge in New England, which sent bills up $30, $40 a megawatt hour for a month this past winter, like these are charges that are in here. No one's going to eat these costs. Suppliers are not going to eat these costs if they can't hedge them out. So understand that, understand what's included in the ancillary, what's not, how they're doing it, all this. And so just remembering these couple of things here. All these charges are going up. We actually expect these non-energy charges to go up in a bigger percentage than actually energy alone. And that's because if you look at the three major ones, capacity, transmission, ancillary. Capacity is all about, is procuring more capacity to satisfy the grid, to keep it a reserve margin in those hottest summer days or really cold winter days, right? It's to keep that level, right? So as obviously I've read the stories out there. Nothing new here. More and more capacity is going to be needed. So that's going to go up. Transmission, our grids need to be updated. We need more transmission lines. All this, of course, with the new generation that comes on, the green over, those costs go up too. Both of those are demand-based charges. We can work on demand-based charges. I'll tell you this in a second. In an ancillary, that's just keeping the grid at 60 hertz. That's just keeping it there, keeping it level, keeping it there. And as more and more stuff's coming online, that it creates this volatility. And with the volatility, the ancillary charges kind of really can go up. As we saw when we were firm with a lot of these PGM, we've seen some of these ancillary charges go up as well. So all these can be changed. The non-energy charges can be changed. It's just a choice of the bill. Demand-based charges are heavily on the distribution side and also capacity and transmission. And that's one thing that we can help you work on. One thing is demand response easily in PGM here for your capacity numbers and the customer's capacity numbers. And number two, demand-based charges and transmission. And we can all work on this and figure out ways, and smoothing out, of course, your peak demand, which changes your distribution charge as well. Typically 80% of your distribution charge is demand-based charge based on the highest peak demand. So let's go. Let's get together. Let's try to get more business by bringing this knowledge to our customers and our prospects, and changing the way that they're buying based off of how it is, because it's kind of a misconception of how this is done, and also making sure that we're telling the truth to our customers when we're speaking to them, and not talking about, hey, yeah, this is guaranteed fixed, nothing's going to change in this. Let's make sure that's not the conversation, that we're truthful, honest right away off the bat, because one, we want to make sure that, you guys are keeping customers for the long term and not just the short term one fit all contract, and there's upset and maybe they're trying to get out of the contract with something you said, which they could have legal right to do. All right, let's just keep going here. Okay, Thrive 2026, September 29th through October 1st in LA. This is great. I mean, first of all, it's going to expand your partner ecosystem, fuel growth with new offerings and sales channels, and you're going to meet key energy suppliers. We'll have a team there. This is out direct, our major company, and within there's a lot of services you could go out and be selling as well. And this is typically cost, I think in early bird rates like $900, $1,000, but then it goes up to $1,300. But it's free. Just get a code from your account manager. It is free with that code, and there's also, they provide you with flight and hotel discounts as well. So hope to see you there out in LA. Get that marked on your calendar, get set, get going. Your account manager, like I said, can provide more information, and we'll be sending out some more material as well. Really awesome. Every year there's also a great keynote speaker. This year it's one of the very early people on with OpenAI, forefront of really talking about innovation within the AI sector, and how you can apply that to your business.
Yeah, Thrive is so much fun. It's so cool. It's awesome to be able to get to see all of the different things that AppDirect does. Box is pretty well established in our space, and we make it our business to be energy experts and be in these markets every day. But it's really fun to go and see kind of the software plays and some of the ways that AI is being integrated, especially for all of you guys, because I mean, all of our agents are individual entrepreneurs. There's a ton of resources and tools that are available via AppDirect. That you can demo, that you can see and hear about directly from their founders at Thrive. So super cool stuff, and really highly encourage everybody to check it out. Hope to see you there.
Excellent. And social media, here we are. Just look us up. LinkedIn is a great place to follow us. We have tons of material that comes out there almost on a daily basis. And YouTube, like this webinar will be on YouTube here, and how you're watching it, because we had to tape it, unfortunately. So again, apologies for all that. And we're also looking forward to next month, probably changing up the format of this a little bit, a little more of a podcast kind of like mode with really kind of having guests on and doing these Q&As, and we'll be like a more studio format. So we're excited to unleash that. Our goal is to do this in May. Don't hold me to that. If it turns out to be June, we'll be on the same kind of format we have now, but we are looking to do that, and it's gonna be much more interactive, much more fun, and you'll be able to follow it. In the meantime, in the market update, we won't really have a very big market update on there. So I'll just be putting out these 5-minute like market updates during the month as well. So look for that on LinkedIn. It'll be released, and also through other social media places. So have a great rest of the April here, and we'll be talking to you guys next month sometime. Take care. Bye.
Thanks, everybody.